Students, in our previous video, we discussed about the systematic risk, that is the risk associated with the external factors and or market, and which is not under the control of any individual company or an individual investor. Today, I will be discussing about the unsystematic risk. So before to that, I also will show you the different events that have created the bull and bear run in the Indian stock market. If you see this chart, during August 2007, from April 2007 to 2nd December, there was inflow of foreign institutional investment and there was high GDP growth, and hence it the graph shows the bullish trend, that is the upward trend in the market. After 2nd December 2007 till 2nd April 2009, it has shown due to global financial crisis there was a downward trend, that is it has showed the bearish market. Again, recovery happens. Market has to recover, corrections has to be made by the government, some corrective actions has to be taken by the government, and hence there is a recovery, that is from 2nd April 2009 to almost 2nd December 2009. It is a recovery stage. Corrective measures would have taken and recovery of the economy would have happened. Again, due to depression or slowdown in the economy, from 2nd December 2010 to 2nd December 2011, there is a bearish market. So this is how the market moves based on different factors that affects the market. Next, coming to unsystematic risk. Unsystematic risk, it is unique and peculiar to a firm or an industry. That is, it is specific to a particular firm or a particular industry. It stems from the inefficiency of the management, technological change in the production process, availability of raw material, changes in consumer preference, and labor problems. The nature and magnitude of these factors differ from the industry to industry and company to company. They have to be analyzed separately for each industry and firm. The changes in the consumer preference will affect the consumer products like televisions, washing machines, refrigerators, etc., more than they affect the iron and steel industry. Technological changes affect the information technology industry more than that of consumer product industry. Thus, it differs from industry to industry. Financial leverage of the companies, that is debt equity portion of the companies, differs from each other. The nature and mode of raising finance and paying back the loans involve a risk element. All these factors form the unsystematic risk and contribute a portion in the total variability of the return. Broadly, unsystematic risk can be classified into business risk and the financial risk. Business risk is that portion of the unsystematic risk caused by the operating environment of the business. Business risk arises from the inability of a firm to maintain its competitive edge and the growth or stability of the earnings. Variations that occurs in the operating environment is reflected on the operating income and expected dividends. The variation in the expected operating income indicates the business risk. For example, take two companies ABC and XYZ. In ABC company, operating income could grow as much as 15% and as low as 7%. In XYZ company, the operating income can be either 12% or 9%. When both the companies are compared, ABC company's business risk is higher because of its high variability in operating income compared to XYZ company. Thus, business risk is concerned with the difference between revenue and earnings before interest and tax. Business risk can be further divided into external business risk and internal business risk. What is internal business risk? That is the risk associated with the operational efficiency of the firm. The operational efficiency differs from company to company. The efficiency of operation is reflected on the company's achievement of its preset goals and the fulfillment of the promises to its investors. Internal business risks occur due to some of the factors like fluctuations in sales, research and development, personnel management, fixed costs, and production of single products. All these factors leads to internal business risk. In any organization, a certain sales level has to be maintained. It is common in business to lose customers abruptly because of consumption, because of competition. Loss of customers will lead to a loss in operational income. Hence, the company has to build a wide customer base through various distribution channels. Diversified sales force would help to tide over this problem. Big corporate bodies have long chain of distribution channel and small firms often lack this diversified customer base. Sometimes the product may go out of style or become obsolescence. It is the management which has to overcome the problem of obsolescence by concentrating on the in-house research and development program. For example, if Maruti has to survive the competition, it has to keep its research and development section active and introduce consumer oriented technological changes in the automobile industry. This is often carried out by introducing sleekness, seating comfort, and brake efficiency in its automobiles. New products have to be produced to replace the old one. Short-sighted cutting of R&D budget would reduce the operational efficiency of any firm. The personal management of the company also contributes to the operational efficiency of the firm. Frequent strikes and lockouts results in loss of production and high fixed capital cost. The labor productivity would also suffer. The risk of labor management is present in all the firms. It is up to the company to solve the problem at the table level and provide adequate incentives to encourage the increase in labor productivity. Encouragement given to the laborers at the floor level would boost morale of the labor force and leads to high productivity and less wastage of raw materials and time. Fixed cost. The cost components also generate internal risk. if the fixed cost is higher in the cost component. During the period of recession or low demand for product, the company cannot reduce the fixed cost. At the same time, in the boom period also, the fixed factor cannot vary immediately. Thus, the high fixed cost component in a firm would become a burden to the firm. The fixed cost component has to be kept always in a reasonable size so that it may not affect the profitability of the company. Single product. The internal business risk is higher in the case of the firm producing a single product. The fall in the demand for a single product would be dangerous to the firm. Further, some products are more vulnerable to business cycle while some products resist and grow against the tide. Hence, the company has to diversify the products if it has to face the competition and the business cycle successfully. For instance, Hindustan Liver Limited, which is producing a wide range of consumer cosmetics, is thriving successfully in its business. Even in diversification, diversifying the product in the unknown path of the company may lead to an internal risk. Unwidely, unweighted diversification is dangerous as producing a single good. These are some of the internal factors that affects the business and leads to business risk. Now, what are the different factors which are external to the organization and which are specific to only a particular company? External risk, it is the result of operating conditions imposed on the firm by circumstances beyond its control. The external environments in which it operates exert some pressure on the firm. The external factors are social and regulatory factors, monetary and fiscal policies of the government, business cycle, and the general economic environment within which a firm or an industry operates. A government policy that favors a particular industry could result in the rise in the stock price of the particular industry. For example, the Indian sugar and fertilizer industries depend much on the external factors. Social and regulatory factors. Harsh regulatory climate and legislation against the environmental degradation will impair the profitability of the industry. Price control, volume control, import export control, and environmental control will reduce the profitability of the firm. This risk is more in industries related to public utility sectors like telecom, banking, and transportation. The government's tariff policy of the telecom sector has a direct bearing on its earnings. Likewise, the interest rates and the directions given in the lending policies affects the profitability of the banks. The Pollution Control Board has asked to close most of the tanneries in Tamil Nadu, which has affected the leather industries. Political risk. It arises out of the change in the government policy. With change in the ruling party, the policy would also change. When there was a Manmohan Singh as a finance minister, liberalization policy was introduced. During the BJP government, even though efforts have taken to augment the foreign investment, more stress is given to Swadeshi products. Political risk arises mainly in the case of foreign investment. The host government may change its rules and regulations regarding the foreign investment. From the past, an example can be cited. In 1977, the government decided that the multinationals must dilute their equity and share their growth with the Indian investors. This forced many multinationals to liquidate their holding in the Indian companies. The fluctuations of the business cycle will lead to fluctuations in the earnings of the company. A recession in the economy leads to a drop in the output of many industries. Steel and white consumer goods industries tend to move in tandem with the business cycle. During the boom period, there would be hectic demand for steel products and white consumer goods, but at the same time they would hit much during the recession period. At present, the information technology industry has resisted the business cycle and moved counter-cyclically during the recession period. The effects of the business cycle vary from one company to another. Sometimes companies with inadequate capital and consumer base may be forced to close down. In some other case, there may be a fall in the profit and growth rate would decline. This risk factor is external to the corporate bodies and they may not be able to control it. Financial risk. How does financial risk affect the company, individual company, and a company as a whole? What is financial risk? It is the variability of the income to the equity capital due to the debt capital. Financial risk in a company is associated with the capital structure of the company. Capital structure of the company consists of equity funds and borrowed funds. The presence of debt and preference or equity capital results in a commitment of paying interest or prefixed rate of dividend. The residual income alone would be available to the equity shareholders. The interest payments affect the payments that are due to the equity investors. The debt financing increases the variability of the return to the common stockholders and affects their expectation regarding the return. The use of debt with the own funds to increase the return to the shareholders is known as financial leverage. Debt financing will enable the corporate to have funds at a low cost and financial leverage to the shareholders. As long as the earnings of a company is concerned and the company earnings are higher than the cost of borrowed funds, shareholders' earnings are increased. At the same time, when the earnings is low, it may lead to bankruptcy to equity shareholders. As the bondholders receive only fixed interest rate, whether company does well or not, the increasing earning per share would cause a change in the capital appreciation and hence there is an impact of the earnings to the equity shareholders on the company. In the year 1998, the economic climate has changed and there is a fall in the operating profit by 33.33% for the companies that are taken in the illustration. As the financial risk considers the difference between EBIT and EBT, the business risk causes the variations between revenue and EBIT. The payment of interest will affect the eventual earning of the company stock. Thus, volatility in the rates of the return on the stock is magnified by the borrowed money. The variations in income caused by borrowed funds is highly leveraged in leveraged firms are greater compared to the companies with low leverage firms. The financial leverage or financial risk is an avoidable risk, but it is the management which has to decide how much to be funded with the equity capital and borrowed capital. So, students, you should be aware of the different types of risk associated with the company and its effect on the business or effect on the prices of the shares. Hope you got a clarity on the types of the unsystematic risk. Thank you for listening.